The Fed slashes rates by 50 basis points and risk rallies hard. Yesterday, the FOMC committee decided to cut rates by 50 basis points, keep their balance sheet unwind program intact, and also try to signal to the markets that everything is just fine. I have 19 fresh charts for you today. We're going to discuss what the Fed did yesterday, what they said yesterday, how the markets react, what our outlook is for risk markets, and of course, we'll look at the Bitcoin price and see how this rate cutting cycle is going to affect Bitcoin. Now, I want to start with the way that we think about financial markets here at the Bitcoin layer. It's a little bit different than the traditional way to think about how the economy interacts with risk. So, in the traditional textbook way, and this is part of what I teach myself at business school, is that a strong economy should lead to higher stock valuations because a strong economy leads to more consumers that are healthy, spending, and that spending translates into corporate profits. When the economy slows, those profits will decline. And in that way, we have a very simple way to approach financial markets that what we're basically doing is trying to judge where the economy is. And we've discovered here over the last few years that that is too basic of a way to approach financial markets. And there's this concept that we're working with more now, which is liquidity. It's the size of the banking system and the ability of the financial system to create credit and to create money. And that money creation and credit creation is what fuels markets, not necessarily just the economy by itself. So that is the premise that I want you guys to take, not only today, but throughout the rest of your macroeconomic study, that it's not just a one-to-one relationship with the economy and stocks. There is this huge supply of debt around the world, over 300 trillion of debt, and that debt has to be rolled. The ability to roll that debt, it comes from two places. Of course, the borrower's ability to prove that he, she, or the company can pay it back, but also the bank's willingness to extend that loan again. And the bank's willingness to extend the loan is the primary dynamic that makes all of these markets tick. And so we have identified one metric that we can track it most closely, and that is the MOVE index. So you guys can follow it at home. What we've done with MOVE is we've combined it with other system-wide metrics, including the size of the banking system and the level of interest rates, which translates into those collateral prices. But the dominant metric within our TBL liquidity index is the MOVE index. And MOVE measures bond volatility. So I'm going to explain to you right now why bond volatility is the number one metric that we need to determine how things are going in the financial markets with specific regard to risk. So that includes stocks and Bitcoin. The Bitcoin layer is proud to be sponsored by Unchained, the leader in Bitcoin financial services. Unchained empowers you to take full control of your Bitcoin with collaborative multi-sig vaults where you hold 2 of 3 keys and benefit from a Bitcoin security partner. This is a really important feature. You can purchase Bitcoin directly into your cold storage with Unchained's trading desk and completely eliminate your exchange risks. Unchained also offers the best IRA product in the industry. You can convert easily your 401k or IRA into Bitcoin while keeping control of your keys. Don't pay more in taxes than you have to. Go talk to them today, unchained.com/TBL, and make sure you use code TBL for $99 off when you create an account. Now, I want to suggest that you guys go subscribe at thebitcoinlayer.com/subscribe to our free research publication. And people also have the opportunity to join as TBL pros. That gives you access to our weekly quantitative risk report. And in that report, we are giving you TBL liquidity. This is our new metric. Now, my goal today right now is to break down why move is so important. I'm going to try to give you the most basic explanation I can. Remember what I said about recessions and the economy and stocks. We are trained to think that a recession is bad for the stock market and a booming economy is good for the stock market, but that's too simplistic. So let me explain why bond volatility is way more important. Remember that we have $300 trillion in debt. We have banks, financial services providers that need to extend that credit time and time again. So the role of the credit. So the banking ability to provide that role has to do with what? Basically, it has to do with their confidence on the path of interest rates. If they are certain that interest rates are going a certain direction or that they are calm, then they will be more likely to extend the loan. And that includes buying U.S. Treasury securities themselves. And of course, it includes lending money against U.S. Treasury collateral. So what is volatility from the MOVE index, or you guys might be familiar with the VIX? The VIX is the volatility index on the S&P 500. Now, these volatility indices are implied, not realized. What does that mean? Realized volatility is a statistical measure called standard deviation. So what is a standard deviation of returns? It looks at the movement of the stock market yesterday, the day before, and it calculates what is the average movement of the stock market. That's realized volatility. So volatile means something is going up or down, right? And the realized volatility is how much it moved in the past. So that's why it's called realized. So realized volatility is backwards looking returns that have already happened. So if you guys are familiar with the Sharpe ratio, that looks at returns relative to volatility. It's looking at realized volatility. What happened in the past? But implied volatility doesn't look at realized returns or realized vol. Implied volatility, which is what the VIX is and the MOVE is, implied volatility is how much options traders are pricing in for the market to move going forward. So implied volatility is forward-looking volatility. Realized volatility is just the standard deviation of returns, past, backwards looking. Now, backwards looking volatility tells us how things moved, but it's not that relevant to future market moves. The reason we look at implied volatility is that how is implied volatility derived? It's derived through options pricing. So that's the basics of realized versus implied volatility. Now let's think about what are options. Options are financial instruments that allow us to protect our portfolio. So forget about call options entirely for a second. Just think about put options. A put option is a contract that you buy that allows you to put your asset to the counterparty below a certain price, regardless of what happens to the price of that instrument. For example, if I own Bitcoin at $60,000 and I buy a put with a strike price of $50,000, what I'm doing is if Bitcoin suddenly goes from $60,000 to $30,000, I can take that one Bitcoin, and because I've bought a put option already, I can put it to the counterparty, whoever sold me the option. I can give them that Bitcoin, and they will have to pay me $50,000, not $30,000. And so I protected myself from $20,000 of downside because I bought this put option. Now, was the put option free? No, it cost money. That money is called a premium. And the premium that we pay for put options is like our insurance premium. If the more risky a driver you are, the higher your insurance premium will be because you're more likely to get into an accident. And so if something is volatile looking backwards or has the historic volatility, that would make options more expensive. But what if there's uncertainty? Now let's bring in the VIX and the move. What if there's uncertainty? Would you be more or less willing to pay for protection? More. So what do put options give us? They give us certainty in an uncertain world. What is the reason that uncertain interest rates are so bad for financial assets? That's what I want to unpack with you today. And the opposite is also true, which is that certainty on the interest rate front. The ability for investors to know the path of interest rates, or to know that they won't be dramatically surprised by the path of interest rates. What does it make them do with regard to put options? More likely to buy or less likely to buy? The answer is less likely to buy put options if we believe that we are confident in the path of interest rates. So let's review all of what I've just taught you. Number one, the MOVE index is like the VIX. It measures the implied volatility of the bond market, treasuries. What would drive the MOVE index or the VIX index up? More fear. And more fear causes more put options buying. More put options buying increases the volatility that's implied by the market. And higher volatility implied by the market, which comes from the uncertainty itself, is detrimental to risk prices because the banking system is less willing to lend, less willing to buy treasuries, and less willing to lend against treasuries because the price of those treasuries could go down more than they thought could have happened. And so let me bring now the first chart of the day. Thanks for sticking with this little explanation here because it's really important to understand. A lot of you are confused. Why does a rate cut of 25 versus 50 make the stock market go up or down? None of that matters. Actually, what matters more than anything is bond volatility, which has to do with certainty, and it actually has to do with the Fed. Now, in this chart of the MOVE index, I took a trailing 10-year snapshot of this index so that you can see the different regimes of MOVE. And what do I mean by the regimes? The first blue arrow that trend lasts for about 5 years. Then there is a disruption in the world. It starts in 2019 in the lead up to the repo crisis. It continues 2020. And it continues in 2021, 2022 with the inflation wave. Now, in 2023, we see the regime shift and MOVE starts coming back down. So what is happening here? The blue arrow is 5 years of muted volatility because the Fed was on hold. They started to raise rates a little bit. 2016, 2017, they were hiking rates, quarter basis point a quarter. So a very slow pace of rate increases. Does that give a lot of uncertainty or certainty to the market? Clearly, it gave them certainty. They weren't worried about a sudden 2% increase in interest rates. Rates were going up 1% per year. The economy was doing just okay. There wasn't really any momentum on either side of the bond market, and that kept volatility quiet, and more specifically, implied volatility quiet. And so stocks did well during that time. 2019, 2020, you had disruptions in volatility, But what I want to look at here is the 2021 and 22 era, in which you had an extreme uptick in move, which meant a huge wave of uncertainty with bond prices. Why? Inflation. Inflation took a grip and made everyone want to sell their treasuries, because if a treasury promises you 2% a year for 10 years and inflation is starting to look like it's 7%, you want to be as far away from that 10-year treasury as physically possible. And so the whole system is trying to get away from it. And you can see that with this increase in volatility. So what do you have actually going on in the market? Put buying, put buying, put buying. So all of the puts that were bought in 21 and 2022 translated to a weak stock market. You remember what happened in 2022 with the stock market. It really struggled. And was it because of rates going up? Not just that. Okay, it was also the uncertainty of the pace of the increase of interest rates, not just the increase itself. So what happened yesterday? Now let's bring it back to the Fed. What happened yesterday? The Fed cut rates by 50 basis points. It indicated it was going to cut earlier this year. It guided the market toward about 1% of cuts before the end of the year. It didn't push back on anything over the last few weeks in the media. So we knew that rates were going to come down. And we know that they're going to come down another 2% or so at least here. So rates are coming back down to 3% or lower. That's our base case, and that's the way that we're approaching. So now let me tell you, with the Fed, let me ask you this. With the Fed cutting rates by 50, what is the certainty on the path of interest rates? Or let me ask it to you a different way. How much uncertainty is there? And how much worry is there that Treasury yields are going to spike to 5% right now? Not much. And so what happens with muted volatility due to higher certainty? More money creation. And so that's why you get risk on. It's these immediate mechanisms that we are trying to understand, we're trying to teach to you so that you interpret these moves better. Don't look at every eco release, because the economic releases, yes, they guide the Fed over a long-term time horizon, but what actually matters for risk? We're showing you and we're telling you that it's bond volatility. So it's basically, if the Fed gives the market certainty, that will be supportive to risk markets. The Fed saying we're not going to just cut by 25. We told you guys over the last month that baby cuts are not going to do it. 25 isn't going to do anything. It's actually going to strengthen the dollar to the dangerous point. We're going to talk about the dollar and Bitcoin and gold at the end of this video. Okay? So it's not the interest rates themselves coming down. It's the certainty that pumped the market. Stocks at an all-time high today. Bitcoin up 6% or so over the last 24 hours since the Fed met. We're recording this on Thursday, September 19th here, while we're in the middle of the risk session. Now, in this second chart, I show you the MOVE index, which is in orange here, versus the stock market in green. This is just looking at a 3-month time horizon. And you can see the spike. Remember that MOVE here is inverted on the index. So on the right-hand side, your y-axis is inverted to measure the VIX. Why do we do that? Because a lower bond volatility is good for stocks. So we like to see the shape in the way that these assets move versus the implied volatility. So right now, stocks are making their all-time high. You don't see that on this chart because this is yesterday's closing price. But you can see the shape, the correlation. Lower move, higher stocks. Lower move means more certainty, less put option buying. Why do you buy puts? When you're uncertain. So when the put buying stops coming, the stock market juices. That is the guiding light for everything that we should be thinking about here. So does it matter if the Fed is cutting by 25 or 50 or 75 or 100? Or does it matter more that we know the Fed is cutting, we know that Treasury yields are not going to 5%? Now, what is the asterisk here on Treasury yields going to 5%? A massive steepener of the curve that's due to the Fed actually getting out ahead of this problem of the economy and actually bringing back growth. The problem with bringing back growth is it's going to bring back inflation at the margin, and yields could go up off of the back of that as investors sell their 10 and 30-year treasuries because they're less certain on the path of inflation. What will that do? Bring back put buying. What will that do? Knock stocks down. All right, let's talk about the money markets. I want to talk about the cut, and I want to talk about the balance sheet today and what the Fed is thinking about, why they're not winding down the balance sheet and the dangers there. First, let's look at this Sofer chart relative to Fed funds and the policy window. Now, the chart looks funny today, and it's technically not complete, or it's a little bit of an error, but I wanted to show you what it looks like. Now, the reason that you have 4.8% there on reverse repo and 4.9% on the interest rate on reserve balances already, but the rest of the rates are in 5.3 to 5.5 land, is that on my macro bond software, two of these rates updated just because of the way that certain rates are published or the timing of the data and the way it comes through to my software, that two of these rates that we track actually reset lower by 50 before this chart was struck, but the rest of them didn't. So tomorrow when I strike this chart, everything will shift back into this 4.8 to 5% range from the 5.3 to 5.5. But the repo rates and the discount rate, which is only updated on this data series once a week, those rates will all come down. But I just wanted to show you what it looks like when there's a cut. When there's a cut, the Fed cuts each individual rate by 50 basis points. It cuts the RRP rate by 50. It cuts interest rate on reserve balances by 50. It cuts the discount rate by 50. And therefore, Fed funds is guided down by 50. Repo, which is Sofer, is guided down by 50. So that's how it works. The Fed has a window. They have policy rates. They move them, and because of arbitrage, the rest of the market obeys. Now, here's the gaslighting. This is an economic chart, but I want to stay within the money markets framework right now, just so you think about what the Fed did yesterday. They cut rates by 50 with GDP at 2.9%, the consumer still pretty strong, and stocks at an all-time high. So why did they do that? This is what I want to mention about having the right framework and the right ability to understand where the Fed is going and why they're doing this. If you remember, for the past year, we had a bunch of analysts saying there's no way the Fed can cut because the economy is too strong. GDP is at 3%. We're not in a recession. Well, guess what? None of those were the actual reasons the Fed cut rates. We weren't in a recession. Obviously, GDP is at 2.9%. Stocks are not in a crash formation. They're at an all-time high, the exact opposite. So why is the Fed cutting rates? There's a couple different reasons. Number one is they're really scared about the forward-looking economy. Number two is that 5.5% was way too high to get to in the first place. They did it because of the emergency of inflation, but they went too far. So now they have to walk a lot of that back. But under the hood, what people don't see is that the Fed isn't there to help you, the U.S. citizen and the U.S. consumer, the U.S. borrower. They're not there to help you. They're there to help keep the financial system stable. And so who are they there to help? Banks, not you. And so how does cutting rates help banks? What do banks own? A lot of what they own is treasuries. Where are treasuries yielding? They are yielding 3%, 3 point something. Where is their repo rate? It's at 5.3, for crying out loud. What are they doing to the banks with rates at 3.5 and repo rates at 5.5? They're crushing the banks. Every night, their charge on collateral is more than the collateral yields. And that isn't just the case for Treasury collateral. They use repo to finance their whole operation. That is what wholesale financing is. They don't need your deposit anymore. That's why they don't pay you the market rate on the deposit. They're not actually trying to rely on your deposit. They are relying on wholesale funding, which is repo. So they need repo cheaper, not at 5.5%, especially when the collateral that they're financing is yielding 3.5%. So stop thinking the Fed is reacting to this dual mandate. It's not. It's reacting to the financial system. Okay? They're lying to you when they're saying that, oh, we're balancing inflation and unemployment. No, they're balancing a banking crisis. That is what they are most worried about. So guiding rates down by 50 is their way to relieve pressure off of the banks. Now, I know that there is a lot going on around the timing of the rate cut versus the timing of the U.S. election. We're not going to speculate on that, especially because we have been calling for the Fed to cut rates since December, okay? And that is because we see the lagged effects of monetary policy going through the economy, the real economy, which we're going to talk about shortly here with housing. Okay, I want to show you a few charts here on money markets to show you why I think the Fed really missed an opportunity to discuss the balance sheet. They went with the 50 basis point rate cut. They didn't discuss the balance sheet. The balance sheet is more of a worry than anything else for the financial system. I'm not quite sure why the Fed isn't seeing that, but let's look at these volumes. So Sofer, 2.2 trillion on a daily, that is going to put pressure on the funding markets. And so let's look at that 2.2 trillion in the context of 6.12 trillion in treasury bills, 6.3 trillion in money market fund assets, which are on the rise. Now, money market funds on the rise means that Sofer volumes are well funded, or they're more able to be funded. Because where do they get their funding? Where do those dealers fund their treasury inventory? From the money market funds themselves. That's your money sitting in your brokerage account. Your cash balance is in a money market fund. It gets swept into these larger funds that buy bills, and when they don't have enough bills to buy, they go to the repo market and they lend money to dealers taking treasury collateral. So that's the purple line. That's your money in the Sofer volumes there. Now, bills going up in green is going to be stimulative to the financial system because it will increase liquidity. Why? When banks buy T-bills, they do so by issuing deposits to the recipients of the stimulus funds themselves. So the whole system grows just by the government spending money, even though even though they're issuing new debt. That new debt isn't coming from old money. It's coming from new money. So it's stimulative. It increases the size of the banking system. Now, bills as a percentage of all of Treasury issuance is on the rise at about 22%. We believe that this number is going to go up over the coming years. And the reason being because if the Treasury Department issues too many 30s and 10s, it can disrupt the pricing at that spectrum of the yield curve. And they don't want to do that. They'd rather issue bills. Bills will be inflationary. They are stimulative because of this new money dynamic. How many treasuries does the Fed own? Now, this is going back to what the Fed is doing on its balance sheet. Right now, it owns 3.73 trillion of treasuries. That's 10.6% of treasuries outstanding. Now, if that number continues to fall, what does it mean? That the market has to come up with 95% of the money for treasuries. Is the market able to do that? What happened last time when we got to about 8% in 2020 on this metric? It basically doubled. The Fed had to buy trillions of treasuries, 5-6 trillion. And so with that number coming down, the percentage also coming down, you would expect that the market is going to have trouble at some point, but it's not happening. Rates are coming down. It means that the Treasury market does not depend on the Fed for rallies. It doesn't depend on the Fed for rates to come down. It doesn't depend on the Fed to bring buyers back off of the sidelines from all around the world, including foreign buyers. And the reason it doesn't is because treasuries provide the safest way to store US dollars in the whole world. And so, yes, they have the ability or the option to own other instruments outside of the system, like gold or like Bitcoin. Those two assets are not nearly liquid nor large enough to absorb the amount of capital that comes into the treasury market when global growth slows. That is what's happening right now. And so the Fed is not responsible for this rally in treasuries. That doesn't mean that they won't come back into the market. I still believe that they will be forced to come back into the market. Now, one of the things that we love to do at the Bitcoin layer is study the nuances of the Fed's balance sheet. These are practices that I developed as a U.S. Treasuries trader in an investment manager with over $100 billion in assets. I was in charge for trading a treasury book of over $20 billion in securities plus derivatives. And in that practice, I was trained to study the balance sheet of the Fed on a weekly basis and try to understand how the balance sheet is impacting the rest of the markets, including my asset class, treasuries, from bills all the way out to bonds. Now, in that practice, I have understood more and more that it's not just the liability side or the asset side of the Fed's balance sheet that makes the difference. It's both. We have to always factor in both. So in the last chart, I was showing you the amount of treasuries that the Fed owns on their asset side. But this is the liability side. Now, liabilities are obviously declining as assets decline to match the book. But where is the decline coming from as assets decline? Is it coming from paper cash? No. Is it coming from the Treasury general account? No. The Treasury is keeping a healthy balance there at about $700 billion. Is it coming from repo? Yes. The repo facility has declined over the last couple years. But here's the important thing. Is it coming from reserves? And it's not. So really the decline in the balance sheet has only come from repo over the past 2 years. And that, we believe, is fascinating. It also means that as repo declines to the point that it can't really decline anymore, the next portion of balance sheet decline is going to come from reserves, making us surprised that the Fed didn't do anything on QT. Because if you look at this next chart, the orange line is reserves here. It shows you that reserves have been flat for 2 years. Now they're going to start going down, presumably. That should be dangerous to the financial system, as reserve scarcity will tighten repo markets. And that reserve scarcity is pretty much guaranteed as long as the Fed continues its balance sheet unwind. It also tells me that the reason they didn't do anything yesterday on balance sheet is that they wanted to get the first rate cut out of the way, and then at the next meeting, they'll probably just cancel QT altogether. Just announce the end of it, and it's over. Now, I really believe that this is coming soon. I don't know November or when it's going to come, but the balance sheet will stop declining here to prevent reserves from falling below 3.3 trillion. And I didn't strike this chart, but you guys remember, I have a chart that shows you GDP with reserves as a percentage of GDP. The Fed has admitted that they need about 12% of GDP in reserves just to make sure that interbank wires can go through and furnish the entire economy as it moves. So right now, with reserves coming down toward the 10% of GDP, we believe that it's over on QT, the balance sheet will stop going down, and that eventually it'll pave the way for balance sheet expansion, probably at some point soon, next year. We're not talking about QE necessarily, but just keeping pace with the increases in GDP will require balance sheet expansion, some more purchases of treasuries, perhaps not more purchases of MBS, and we'll see how the Fed wants to behave there. This will be, again, stimulative to financial assets because of a growth in the financial sector balance sheet size. Okay, let's talk about the housing market. We have here a trailing 10-year chart of the Freddie Mac 30-year fixed rate mortgage. Average interest rate has fallen down to 6.2%. That is going to continue to come down as the Fed gets involved in rate cuts. Growth continues. The growth outlook continues to slow. The asterisk again here is that mortgage rates are benchmarked to the 10-year. The 10-year is not benchmarked to the Fed funds rate. And so a declining Fed funds rate might actually send the 10-year rate higher as growth expectations finally get priced back into the market. So we're going to look for the Fed to try to get this borrowing rate as low as it can, because that is going to actually help the rise in delinquencies and defaults that we're seeing in the housing market. It's slow, but it's increasing, and there is trouble on the housing market in parts of the country that we are very aware of. So go check out our latest with Melody Wright on the housing crisis that may be brewing. This morning, we got 3.86 million in existing home sales. Very, very weak, basically at the lowest level in the last few decades. This is showing us that the housing market is it's grinding to a halt, especially in Texas and Florida. Very, very dangerous dynamics, Texas, Florida, and Arizona, that we're hearing on the housing market. Prices are still going up nationwide. That is something that we are going to watch to see if it can turn over. If it turns over, expect to see the Fed getting much more aggressive in their cutting cycle. And so it's the government's responsibility to help home borrowers that are struggling and falling into default, but it's the Fed's responsibility to protect the bond market from blowing up, causing banks to blow up. And so that would be a reason that the Fed comes in, cuts mortgage rates, and even starts to buy mortgage-backed securities if we go into another crisis, even though it's saying that it wants to exit the market. We're not sure that the Fed will be able to do that. This next chart will go to treasuries. I want to show you the 2s 5s yield curve. This isn't a yield curve that we talk about a lot. It's way more nuanced and something that really only the junkies look at when it comes to rates. But the 2-year, 5-year part of the curve is steepening out right now and heading back to positive territory potentially soon, meaning that finally from the 2-year to the 5-year forward-looking time horizon, we're starting to get potentially some growth priced back in. But the only way we can get that growth priced back is if 2s are cut way more than they are priced right now into the market, which is at about 3.5%. We think that they're going below 3 to 2.5% over the next year or so. That would be more appropriate for a yield curve steepener, because 3.5% policy rates is still going to be too expensive versus where the Fed wants growth to really renew and get back that hiring pace we don't think that that hiring pace can really pick up unless the Fed cuts really drastically. The Treasury market is trying to put the Fed there, but still not enough. And this curve being inverted, 2s, 5s, tells us that the amount of cuts priced into the market is still not enough to get that growth impulse back into the market looking forward. In this next chart, I have 3 Treasury futures contracts rebased to 100 trailing 2 years. So what does that mean? If you have $100 2 years ago and you buy 5-year Treasuries, 10-year Treasuries, and 30-year Treasuries, how would your money be doing? If you bought 5s, you'd be right back to even. If you bought 10s, you'd be right back to even. So unchanged for 2 years of Treasury holders. The 30-year buyers are still underwater by about 4.3%. But still, what this tells us is that Treasuries have made a strong recovery over the past year, especially in the long end of the curve. And people that bought Treasuries during 2023 have been rewarded. So we want to just give a special shout out to all the investors out there that are treating their portfolios with this multi-asset allocation approach and understanding that Bitcoin and bonds, they all have a place in a portfolio, but how you choose to allocate is obviously going to depend on your own investment mandates and your own risk tolerance. The idea that Treasuries were in a sovereign debt bubble and that your money would disappear on a nominal basis was unfounded in 2023, and we're glad that we were pushing back against that narrative. Doesn't mean that Treasuries are going to outpace the returns of Bitcoin over any time, long time horizon, or that they are going to outpace your own cost of living at home. That is what we call financial repression, where the yields themselves are lower than the inflation rate, punishing savers and making it more affordable for the government to pay back their debt over the long term. So again, the government putting itself first, the Fed putting banks first before you. Let's switch over to global FX. I want to talk about the dollar. We have here a multi-decade chart of the dollar, and the dollar going stronger over the last 10 to 15 years on this trend. That's with it zoomed way out. And I do think that if the Fed doesn't cut fast enough, that the dollar will strengthen. That can be a danger. So I want you guys to remember that when the Fed is cutting, they have to be thinking about the dollar. When the Fed is cutting, they are weakening the dollar. So if they don't cut fast enough, it will strengthen the dollar. Going to the next chart, the DXY is in this key zone. So this is looking just trailing 5 years or so here on the dollar index. We had an ascending trend line off of the back of all of that bond volatility and higher interest rates over the last couple years. The dollar started to consolidate. It broke down below its ascending trend line earlier this year as rate cuts became locked in and a certainty. We flagged that for you guys when it happened. But now what's happening? You're getting back to the 100 level and the dollar is taking a pause. It doesn't know where the Fed is going to go, if it's going to go aggressive or not. If it doesn't go aggressive enough, the dollar is going to rally. And if it does go aggressive, the dollar will break down. You will see gold, Bitcoin do very well in that scenario. So we're watching the dollar as a signal as to how good is the Fed doing at bringing the dollar down, which is going to be a policy goal for the Fed/Treasury. Gold, we flagged the breakout earlier this year. Gold is basically on track for completing its full breakout. So in a classic technical analysis approach, what we do is we take the range of the consolidation. So you consolidated from about 1,200 to 2,000 over the last several years. That's an $800 consolidation. Breaking out about above 2,200 should put us at $3,000 in basically no time, weeks, months, maybe a year. But gold is heading up there. This breakout of a long consolidation just means that gold has to unlock its next price level. Now, overlaying gold and the Bitcoin chart here over the past 2 years, you can see that the two behave very closely. and they are both reflecting similar realities about liquidity, stimulus, and the Fed and the path of the dollar. Bitcoin has done less well than gold over the last month or two, but we're going to expect Bitcoin to resume its run, especially as the market realizes how accommodative liquidity is going to be, which, remember, it's not just rates, it's not just balance sheet. It is the certainty and the lack of uncertainty on the path of interest rates that will send money creation higher, which will send Bitcoin higher. In the last chart, I show you Bitcoin's upper end of the range without really marking the lower end of the range. You guys know the support that's there in that 50K area, 52K. It does need to hold to prevent a much larger drawdown in Bitcoin. But I am looking at the top end of the range as well, thinking about the risk management, about $20,000 of consolidation as well, between 50 and 70 for Bitcoin. So you can use a similar rule to what we discussed on the gold chart. But basically, even though Bitcoin performed very well over the last 24 hours after the Fed, there can be no excitement below 70K because Bitcoin is still consolidating. And if it tags 70 and still falls back down, that's just keeping with the consolidation trend. So you have to watch for the breakout. But until the breakout, no excitement, and 58K gang all the way. Thanks for sticking with us today. Make sure you subscribe to thebitcoinlayer.com/subscribe for our free research publication. Subscribe to this channel, rate and review if you guys are audio people out there, and we'll catch you guys next time.